In this video, I want to talk about the permanent portfolio. This video will be an update to a video I did about 6 months ago, where I sort of resurrected this sort of portfolio structure created by Harry Browne in the 1980s. I introduced it then and talked about how it had performed over the 10 years ending October 2019. So, again, I was curious, hadn't revisited this portfolio in quite some time. I don't actually follow it myself, but knew about it and know that it's designed to weather sort of all economic conditions. So, 10 years ending October 2019 being quite a big run in the equities, wanted to see how maybe potentially underperformed this portfolio was relative to the equity index. Now, fast forward and May of 2020, obviously in the last 6 months we've experienced some incredible extremes, certainly a major run up in the S&P 500 and the stock market at large, followed by COVID-19, a massive crash in the stock market, massive cuts to interest rates, gold hitting new highs. And so I wanted to give sort of an update to the portfolio. What has it done, extending it now a further 6 months. So I'm actually looking at it over 3 different periods, which I'll cover in this video. So stay tuned for more. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder. I've been managing my own money for over 20 years and have created this channel to share with anyone who's interested the thought processes, ideas, and strategies I use to manage my own money, but also to share other thoughts and ideas, things I think about and have discovered along the way, like I'm doing in this video. So if you do have any thoughts or ideas of things you'd like me to cover in the future, please feel free to leave a comment in the comment section, and if you do like the video, of course, do give me a thumbs up and hit the like button. Now, without further ado, let's jump into the details. So like I said, this is the permanent portfolio, 25% equities, 25% cash, 25% bonds, and 25% gold. That is the portfolio in a nutshell, not more or less complicated. I will also link, however, to the videos where I cover both the introduction of this portfolio and also the second video, which I showed how to construct your own if you are interested. So that being said, just as a reminder for those who are new to this topic, permanent portfolio, again, created by Harry Browne in the 1980s. His objective of the portfolio is not only to preserve capital, but also to increase the real purchasing power of that capital over time, meaning that net of inflation, the capital does grow over time, so that there's actual real return there, not just an effort to keep up with inflation. The 4 asset classes are designed, have been selected because they do together, they are able to withstand, or should be able to withstand, all seasons of the economy. There is limited correlation, some with 0 correlation, others with negative correlation to one another, so that's a very good thing when you're looking at asset classes. They shouldn't be highly correlated, otherwise you're not really diversifying. That's the thought process, of course. So the 4 asset classes, stocks obviously rise in value as the economy recovers or improves. Bonds rise in value as interest rates fall, so you have an inverse relationship there between bond values and interest rates. Gold generally rises in value when inflation is rising, and cash rises in value during times of deflation and also provides liquidity to a portfolio. So that's the premise behind the portfolio. This was, again, Harry Browne's creation, not mine, but something that I think is interesting to look at, basically because of the simplicity of the portfolio. It really is about the easiest thing out there to follow for any investor, even if you don't really have any time to put to investing. So that's why it's kind of interesting for me just to see how something this mindless and this simple actually performs relative to the broader market. So I did mention I wanted to update my previous video. So my previous video, I shared the time period from October 09 to October 2019, full 10 years. Interesting time, of course, given the massive run-up in the stock market. I wanted to just extend that period by 6 months, given the sort of crazy time we've seen here in the economy, in the world, with COVID-19 and all the goings on there that have happened. So the permanent portfolio in this graph, as you can see, is the green line. So kind of running up there through the middle. The blue line, of course, being the S&P 500, represented by the ETF SPY. The long-term bond or bonds section of that permanent portfolio is represented by the orange line, ETF TLT. GLD represents gold. You can see it kind of swinging down here through 2015 and then coming back up, of course, again to kind of new recent highs anyway in 2020. And then cash is basically represented by short-term bonds, which is used as a decent proxy for cash, only because of the insensitivity of short-term bonds to interest rates, and also because you don't really get any return in a money market fund. So there you go. That's the permanent portfolio. Has kind of tracked fairly steadily over the years, not much volatility. Even with this recent swing, you can see when interest rates were cut here in recent times through the end of sort of 2019 into 2020, long-term bonds jumped up, which is typical given they're very highly interest rate sensitive, and that sort of offsets the down in the stock market, and of course you see gold rising as well. So how that played out over that period, basically equity showed an annualized return of 12.2%, bonds 8.3%, gold 4.2%, cash 1.3%, and then permanent portfolio 6.1%. So you could say, well, that's not a great return over that time for the permanent portfolio, given what you could have earned in equities. Certainly the graph we just saw showed a fairly high, much higher rise in equities than the permanent portfolio overall. At the same time, though, October 2009, obviously after the bottom of the 2008 financial crisis, and you're riding that up through that time, so that's pretty good timing. But maybe you hadn't known that was the time to kind of jump in. There had been some interesting discussions around that period as well. Is it going to continue? Is the stock market going to continue to recover? Is the economy going to continue to recover? How long till the next recession? All those things, right? I mean, this is a pretty epic long bull market. Did you know that was going to happen? I can't say I did for sure. I mean, obviously, that's always the hope, but we hadn't seen something like that before. So if we just look then at the same portfolio and we just take it just back to the prior peak, so right at the beginning of 2008 and 2007, the stock market was basically at its very peak, right before the financial crisis hit in 08. And so let's just pretend for a moment that you had invested your money right at the peak of the market before everything fell in the last financial crisis. How would the permanent portfolio have performed? And again, you can see the permanent portfolio is in the green, stock markets represented by SPY in the blue, long-term bonds orange, gold gray, and the cash in yellow. So if you had gone kind of all in, you still would have done better in the stock market, but you can see that permanent portfolio, aside from a bit of a swing down in 08, calendar 08, where the stock market fell over 40%, so that would have been a pretty heavy punch to the gut. And would you have known just to stay in it, and will it come back? Hard to say. That was a pretty big swing down. At the same time, permanent portfolio, I think that the biggest dip it saw was about 11%, so not terrible given what the rest of the stock market was doing, and kind of there it goes on its merry way basically outperforming the stock market until about 2013, where they actually crossed paths, and then away goes the S&P 500 until the big spike down. So, and of course the bounce back recovery. So how I was just interested, if you'd really not timed it well and put all your money in, how would they have compared in terms of overall returns? Well, equities 8.2, bonds 7.7, gold 4.6, cash 1.5, and the permanent portfolio again at 6.1%. So, not that shows how much it's able to withstand volatility. Going from 12.2, having put the money in October of 2019, versus 8.2, having put the money in January of 2008. That's a pretty big difference in returns. So pure equities 8.2%, permanent portfolio 6.1%. That's not a bad thing. Also you would have had to withstand a 40% plus decline in the in two periods, basically in the 2008 crisis, and then again at least 20% in the most recent drawdown here. So it questions, or I guess one of the questions you have to ask yourself as an investor is, how good am I at stomaching volatility? If you're really good at it, then maybe this is just great, and you'd rather have the extra 2.1%. Fine, but maybe that's too much for you to handle, and a smoother curve, even with a lower return, is actually a better thing for you. So that's obviously a very personal preference or opinion that you have to consider for yourself, but I just thought that it was interesting to look at and consider, because here we have a period where you've hit two big drawdowns, and really the returns comparatively aren't that massive. So just wanted you to consider that. So the last period I wanted to look at, I think, really showcases the power of this permanent portfolio and what it was designed to actually do. So in this most recent period, October 2019 through May 2020, like I said at the beginning of this video, extremely volatile period, big run up in the stock market, COVID-19 hit, massive cuts to interest rates, gold popping up to new highs. Really wanted to see what this portfolio would do over this time period, see if it does or did what it's designed to do, and that is to sort of absorb that volatility, yet still create decent returns. So this chart really showcases exactly that, I think. So you do see the rise in the stock market, followed by the big drawdown, then the bounce back up, extremely volatile, and it's still underwater relative to the original investment of $10,000. Permanent portfolio again in green, sort of just bumping up, a little bit down, then back up, then a little bit down, really not showing much volatility at all. You can see that the long-term bonds, down, then spiking way up when interest rates started getting cut heavily. Gold, of course, bumping up to new highs, so actually both bonds and gold outperforming the permanent portfolio, and stocks underperforming. So again, very interesting. When we look at the actual returns of each of the asset classes over that period, equities down almost 9%, bonds up 30%, gold up 20%, cash up 5%, as represented of course by the short-term bonds, and the permanent portfolio 11.6%. So again, this is what the portfolio is designed to do. It selects asset classes that don't have a lot of correlation between them. When something is down in the portfolio, there's enough of the other asset classes to offset that. That is the point of this, and I think that really hammers home the power of asset class diversification, as touted by other very famous investors, Ray Dalio being one of them in his all-weather portfolio. I do like this particular portfolio only because I think anybody can do it. It is really simple. It is 4 basic asset classes, as can be captured in one ETF each. And I think it's just very interesting to see. You have all these people out there, wizards of the stock market, explaining how amazing they are at getting the returns they get, and even financial advisors, mutual fund managers, all these people saying how awesome their ability is to withstand volatility or whatever it is their case is. But this portfolio, I think, as I've shown in my other videos, which I will link to, of course, at the end of this, really is something to consider for the average person, and is very interesting to look at when you have these sort of concentrated crazy periods. At least I think with this one, I think if you had done it, followed it, if you were doing this yourself, it definitely gives you peace of mind and a way to sleep through the night. So I do hope you did find that video somewhat useful. Again, I think it's interesting just to look at this type of investing, making sure you are diversified across asset classes more than anything. Even if you think you've got the know-how, you certainly have to have the time and the ability to research these. When you're looking at a portfolio of a lot of individual securities, sometimes it's good just to benchmark yourself against things like this, just to make sure that what you're doing is actually working and that the time you're putting in is worth it. So again, something to consider. If you did like the video, please do give me a thumbs up. Always appreciate it, and helps the YouTube algorithms. If you haven't yet subscribed but want to see similar content going forward, then by all means hit the subscribe button. And if you have any comments or questions that you want to ask, then please do leave me a comment in that section below. Like I said, I will link to all of my previous videos on this topic for you to go back and look at as well. So until next time, stay safe and healthy, and thank you very much for watching.